Ladies and gentlemen, good day and welcome to Mars Financial Q2 and H1 FY23 earnings conference call hosted by Motilal Oswal Financial Services Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Abhijit Tibrewal from Motilal Oswal Financial Services Limited. Thank you, and over to you, sir.
Yes, thanks, Vivian. Good afternoon, everyone. Welcome to the Q2 FY23 earnings call of Mars Financial. We have with us today the management team represented by Mr. Kamlesh Gandhi, Chairman and Managing Director, Mrs. Darshana Pandya, Director and CEO, and Mr. Ankit Jain, Chief Financial Officer, and other members of the senior management team. On behalf of Motilal Oswal, we thank the management for giving us this opportunity to host their earnings call today. Let me now hand over the virtual mic to Mr. Gandhi. Post the opening remarks, we will open up the floor for Q&A. Thank you, and over to you, sir.
Thank you, Abhijit, and good evening to all of you. I'm very happy to connect to all of you once again. And before we start, I wish all of you a very happy New Year. In Gujarat, post Diwali, there is a beginning of the New Year. So I wish all of you a very happy New Year, happy, prosperous, and a healthy New Year. While the results are in front of you, and all of you must have gone through that, I just give you the heads up on what we did in Q2. As you are aware that we could register a very robust financial performance, resulting into a 30% YOY growth in AUM, in profitability close to 27%, and maintaining the quality of the assets, high capital adequacy of 24%, and a good liquidity. So all round, it was a very it was a performance which we are used to over all this 2.5 decades. If you plot our performance over last 2.5 decades, where barring the 2 COVID years where we had a calibrated approach on growth, and in the hindsight we all agree that rightly so, we have registered a growth of 25% plus, and this quarter was no different post the normalization. So with this strong quarter, it gives us more confidence on the fundamentals what we have followed over all these 2.5 decades, that we focus on the quality, the asset quality, the dictum of extending credit where it is due, the understanding that the markets are there, will be there. It is very important for us to be very strong and to be there. And the consistent and the strong performance over all these 2.5 decades is a function of this basic, following this basic fundamentals. If you see the growth, it was across all the product lines we operate, while the Shavan will do the number crunching for you, but across all the product lines, that is MEL, SME, two-wheeler, commercial vehicle loan, and we are testing the salary personal loan also, which is a very wide segment to be served. All those segments registered a good growth this quarter, resulting into an overall disbursement growth of 53% YOY and an AUM growth of close to 30.13% this year. On the distribution front, we continue to expand our distribution with close to around 150 branches and 6,250 centers. And also with our strong network of NBFCs, more than 150 of them, they contributed very positively and efficiently during the quarter, with the mix between 60% of the portfolio being through our direct retail distribution and the 40% through our NBFC distribution, which is also working very, very efficiently. And as I always said, that this shift in mix of direct versus the retail asset channel is a function of the growth in our retail asset distribution, and we have very high regards and we have very high confidence in the distribution channel through our NBFCs also. On On the technology front, I think very important to share with you that we are in an advanced stage of digitizing our processes. Within next quarter or two, we'll be seeing all the products seeing a digitized processing, bring about more efficiencies, and will bring about better customer services, and at the same time will help us to have a better control on the assets we create, along with our tie-up with the fintechs of the few of the fintechs of the country. That gives us the complete understanding of the working of the technology and how we should from time to time adapt and adopt the same. In terms of the team, which is which forms an integral part of any organization, as you know that we have a very strong and a solid top and a middle management team, accompanied by close to 500 people working with us for more than 5 years. But as I talk to you, the team currently is in excess of 2,200, and it will get further strengthened as we grow from quarter to quarter. If I talk about the housing finance subsidiary, this quarter I'm happy to report a growth of AUM by 28%, 27% on a YOY basis. And as I always ever shown the confidence that this company will also contribute very meaningfully going forward, and we see this company growing anywhere between 25 to 30% in coming quarters. So all in all, we are back on the track post our calibrated approach post-COVID. If you see right from Q3 last year, we started growing, and now we are at full-fledged growth while maintaining the fundamentals of asset quality, capitalization levels. Currently, we are at around more than 24% of capital adequacy. And it is very important to note that the high level of capital adequacy is based on a non-dilutive growth, whereby the contribution to the capital has been mainly through internal accruals. And as we completed 5 years of our capital raise through IPO, we have more than doubled our AUM profitability and all the other important parameters. But it has been fueled through internal accruals. And with the current business model, we are very confident that we will be in a position to grow anywhere between 20 to 25% going forward. If there is an opportunity, the way we could do it in Q1 and Q2, it can be even more. But we have very strong enablers, and our conviction is based on those enablers, namely the self-propelling capital model, the niche expertise, the large market, and last but not the least, the attitude and the aptitude of the team of being a learning organization and be confident but never be complacent. So all in all, we are happy to report this number, and we are seeing very strong traction for the coming quarter also, and we are very confident of a very strong performance the coming quarter too. With this, I would like to hand over to Darshna to provide the numbers are in front of you, but if you can give the headline numbers for the benefit of the ones who can once again refresh those numbers. Over to you, Darshna.
Yeah, sure, sir. Thank you. Good evening, everyone. So I'm happy to connect with all of you once again. To start with, as shared by Kamlesh, that we can see the growth across the products. So if we look at the AUM, overall AUM has increased by 30.13%. And if we look at the product configuration, micro enterprise loan has increased by 24.07%, that is from 2,893 to 3,590 crore. SME loans has increased by 33.40% from 2,002 crore to 2,672 crore. Two-wheeler loan has increased by 30.16% from 361 crore to 470 crore. Commercial vehicle loan, there is a growth of 19.91% from 228 crore to 273 crore. As salaried personal loan is a new segment, so the portfolio as on September 22 is 133 crore. If you look at the income and PBT PAT figures, total income on Q-on-Q basis has increased by 46.73% from 156 crore to 230 crore. PBT has increased by 27%, that is from 51 crore 53 lakhs to 65 crore 43 lakhs. PAT has increased by 28% from 38.32 crore to 49.07 crore. If you look at the half-yearly figures, half-yearly performance, income has increased by, here also it has increased by 40.33% from 305 crore to 428 crore. PBT has increased by 26.35% from 101 crore to 127 crore. And PAT has increased by 27.20% from 75 crore to 95.59%. Regarding the quality of the assets, we could maintain the quality during this quarter also. The gross stage 3 asset is 2.26% and net stage 3 asset as on September is 1.60% as compared to 2.27% at gross stage 3 and 1.63% net stage 3 as on June 22, and we still hold around 0.37% of our on book asset as our management overlay. So this was regarding the parent company. Now coming to the housing finance performance, AUM has increased by it has increased by 27.38% from 300 crore to 382 crore. Total income has increased on quarterly basis. It has increased by 13.87% from 9 crore 22 lakhs to 10 crore 50 lakhs. Profit before tax has increased by 13% from 1 crore 89 lakhs to 2 crore 13 lakhs. PAT has increased by 13.47% from 1 crore 48 lakhs to 1 crore 68 lakhs. On half yearly basis, the numbers are total income has increased by 7.07% from 18 crore to 19.39 crores. PBT has increased by 20%. That is from 2 crore 95 lakhs to 3 crore 54 lakhs. PAT has increased by 19.62% from 2 crore 31 lakhs to 2 crore 75 lakhs. Here also the silver line is the quality of the portfolio. As on September, our gross stage 3 asset is 0.59% and net stage 3 asset is 0.42% as compared to 0.54% gross stage 3 and 0.38% net stage 3 as on June 22. And here also we hold around 0.98% of our on-book asset as a management overlay. So this was regarding the performance of both the companies. Now I'll request Ankit to take you through the capital and liability management during the quarter.
Yeah, thanks, ma'am. Good afternoon all. To elaborate on the liability management, the company, through its efficient liability management, was able to maintain the average liquidity buffer of around 600 crore this quarter and unutilized cash flow facility of around 500 crore. In addition, the company has sanction on hand to the tune of rupees 2,000 crore with under various facilities in the form of term loan, DA, direct assignment, co-lending, etc. In the last quarter, the company did around rupees 255 crore direct assignment transaction. The company has more than 1,100 crore sanction on hand, which will be utilized during the quarter and the coming quarters. The company aims to maintain around 20 to 25% of AUM as of book through direct assignment transaction and co-lending. In the last quarter, company did around rupees 75 crore co-lending transaction. The company has tied up with 3 banks, namely Bank of India, Bank of Maharashtra, and recently South Indian Bank. Further, we are in process of co-lending tie with few other banks, which we see as a win-win proposition for both the entities. Company has cash facility of around 1825 crore, out of which company maintain utilization level of 65% to 70%, and rest portion is kept as liquidity buffer. We successfully rolled over around 1250 crore short-term working capital this quarter, which is a sub-limit to cash limit. We raised around 722 crore of term loan during the quarter. This helped us to further strengthen the asset liability maturity pattern. We further have more than 700 crore sanction on hand, which we utilize during the current year. Also, we have assessed the structural liquidity for the period ending 30th September 2022, and based on the assessment, there is no negative impact on the liquidity, and the cash flow in all the cumulative buckets remain positive. The capital adequacy ratio remains strong at 24.14%, with Tier 1 capital of 21.24 and debt equity of 4.28 times. Also, to add on, we raised around ₹25 crore subordinate debt during the quarter. This qualifies as a Tier 2 capital for the company, and thereby further strengthening the capital structure. Lastly, the cost of borrowing for the quarter has remained stable at 8.83%, and in the current increasing rate scenario, we are trying our best to hold on it at a comfortable level. So this is on the capital and liability management, and I give a better dice to Kamlesh for closing remarks, and then we can be open for Q&A.
Thank you, Ankit. And now we are open for taking questions for better understanding.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Participants who wish to ask a question may kindly press *1 on your touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Hardik Doshi from White Whale Partners. Kindly proceed.
Hi, can you hear me?
Yes, sir, you can hear.
Yeah, thank you. Hi, congratulations on a good set of numbers. I just wanted to ask about the operating expense ratio, right? It's gone from 1.5% to 2.4%, and I understand part of it is the expansion of the branches and the employees, etc. How much of this movement of, almost 90 basis points, right? How much of it is, timing and, will be gradually absorbed over a period of time? And how much of it is like maybe permanent in nature, given that you want to move more of the assets on book versus off book, and also these tie-ups with fintechs, etc.?
So on that, Hardik, we always maintain that our focus has been on ROA, which is a function of the yield we take and then the cost of the funds and the cost of operations and the credit cost. So the cost of operations will depend upon the growth in various product segments what we are into, and also the form of distribution. So as I shared in the beginning that we increased our branches, we increased our distribution to 6,200 centers. But at the same time, that increases our yield when we work directly as compared to our NBFC distribution channel. So the right way to answer your question is that our focus will be to maintain ROAs anywhere between 2.75 to 3.25%, and the operational costs will differ upon the growth in the various products and the distribution model as we pursue going forward. So the ROA will reflect the real intention of the company to maintain a certain yield and a certain operational cost.
Okay. Got it. So basically, you're saying that the increase in NIM is being offset by the increase in the OPEX as a percentage of AUM, and so on a blended basis, PPOP as a percentage of AUM is remaining.
Right.
Okay. And this 133 crore of AUM that is on the salary personal loan, is that all entirely with the relationships with fintechs, or are we doing it through our branches as well? Can you just, and also can you give a profile of these salaried employees that we're giving it to, a little bit more color?
It's a combination of both. Because if I take you to fundamentally introducing this product, that we were already into the major segments of the economy, be it SME, micro enterprise loans, wheels, fees, including two-wheelers, commercial vehicles, and we are also working hard to gain some momentum in used cars. This was the consumption segment which we were missing since long, according to us. So we are trying to take a baby steps there. So the portfolio what you see is a combination of both. through our tie-up with fintechs and through our branches.
Got it. And these are salaried private sector salary personal loans, right?
Yeah. So we have shared that in brief in our presentation that basically these are the employees belonging to the approved companies having a permanent domicile, and based on their repaying capacity, the loans are extended.
Got it. Okay. Thanks so much, and congratulations again.
Thank you.
Thank you. The next question is from the line of Rahul Jain from Credence Wealth. Kindly proceed.
Hello. Am I audible?
Yes, sir, we can hear you.
Sure. Congratulations on a good performance, and thanks for the opportunity. Sir, just to understand this salary part more in details, you have mentioned in your PPT about approved companies. So typically, two things. Where are these loans going in terms of approved companies would mean what? And this is for what purpose? And secondly, how do you plan to grow this book over next 12 to 24 months? How do you plan to grow this book further?
So answering your second question first, as I told, we are taking the smaller steps as usual, the way we do for any product. So we are not pegged a percentage or contribution of this product towards total AUM. We like to discover that. We are not pegged it. So it all depends upon what is the portfolio quality we get and what is the opportunity we get in the market. On the approved companies, there are certain parameters on which we will approve a company, such as their revenue, the size of the organization in terms of the employees employed, their compliance, their vintage, their compliance on the basic parameters. So we have 5-7 basic parameters on which we would approve a company, and in those companies, the employees working in those companies only will be extended this year.
And these are typically small ticket because the average ticket size is roughly around 24,000.
So this will start like that only. As I told that when we start very in a very calibrated manner. So the ticket size will also increase over a period of time as we gain the confidence and better understanding. But as of now, the ticket size will gradually increase. And the current ticket size is also the function of sourcing our business through certain fintechs where the ticket size is small.
And sir, out of the AUM of 7,500 crores today, how much of it is through the fintechs?
The last quarter we did a disbursement of close to 240 crores, right? 235 crores through fintech, and cumulative in terms of AUM, fintech contributes less than 10%. It is around 7-8% of the total AUM.
Sure. One last question on the AUM segment. So two-wheelers have done exceedingly well in the current quarter, but the CVs continues to lag behind. Anything specific to read into both of these particular things, that two-wheelers is doing very well and CVs do not or continue to not to do well?
I think they're two different products altogether. So if two-wheeler grows, CV has to grow is not given. It all depends upon the opportunity we get at the ground level and our team and origination team and systems and operations and the confidence we get at various markets to extend more loans. So it's a function of so many parameters. But going forward, if I give you a medium-term vision, and we see that this wheels which contributes around 10 to 11% currently should contribute around 20%.
Hello? Hello. Sure. And just one last question, sir. In the growing interest rate scenario, how do we plan to, or what is your confidence level on maintaining NIMs?
So there are two aspects to it. That our capabilities to get the borrowings at the competitive rates, despite of the fact that the rates have increased, and secondly, our capabilities to pass it on to the borrowers. So as I shared last time also, that coming on the second point, that we have 70 to 75% of the loans where potentially we can pass on the interest rate hike to the borrowers. And in terms of our borrowing, majority of our borrowing is MCLR linked, so we get a benefit of a lagged effect in the increase in the rates. And also because of our immaculate track record, we can also bargain on the premiums that the bank charges over MCLR from time to time. So with all these factors and given the vintage and the track record and our capabilities to pass on to the borrowers, I think we are pretty confident of maintaining the NIMs in the medium to long term.
Thank you so much, sir, and wish you all the best. Thank you so much.
Thank you. The next question is from the line of Harshvardhan Agrawal from IDFC. Can you proceed?
Hi, sir. Thanks for the opportunity. So just wanted to understand, among the segments that we report, which segments have floating interest rate loans and which have fixed ones? A connected question to that is, how much interest rates we have increased in that floating book, and what's the frequency of repricing?
When I talk about 70% is the potentiality to convert that into higher rates. As such, practically barring, I think two-wheelers,
SPL and commercial vehicles.
Barring our 10 to 15% of the portfolio, we have an enabling agreement with the borrowers to increase the rates. So you can consider around, conservatively, I'm talking about 70-75%. Of the borrowers where we can potentially have a floating rate. And from time to time, we have raised the rates which on an average basis, we have raised by 0.3%.
So this 30 basis point rate increase, you asked 3 months or over the past 6 months?
Over the overall increase, there has been a repo rate rise of 1.9% from June onwards or May onwards. So during those periods, compensating with the repo rate rise period, we have increased that rate.
Right. And so one last thing that I wanted to understand was, how does the repricing occur? So let's just say you decide that for a particular loan, the interest rate would be increased today. So is it applicable for the next EMI, which is next month, or it would be like after a quarter or some time period?
There is a cut-off date. Say for example, last time when we increased, it was effective 1st October. So on the loan outstanding from 1st October, those rates will increase.
So because 1st October is also start of the quarter, so is it fair to assume that the cut-off dates are at start of the quarter?
It all depends upon our maximum effort is to absorb those rates and don't pass it on. So it all depends upon what are the rates rise we get in turn. So we don't fix the timing of a quarter or a month. It all depends upon how we fare on raising the liability and how we could manage not to get at the increased rate. If we could manage that not to get at the increased rate, we might absorb it for a longer period. But the effort is that how we can be stable on the interest rate to the borrower.
Sure. And so, but just one last thing that I wanted to understand. You said we have taken a 30 basis point increase in interest rate over the last 6 months. So maybe from say May or June onwards, we have taken 30 basis points. Is that correct?
Yeah.
So because if I were to look at the calculated yield, they have increased by a higher rate. So is it because of function of our loan book growth into higher yielding segment, which is maybe salaried loans or something? Just wanted to understand, but that yield increase seems to be more than 30 basis points.
So the 30 basis point was not at one go. It was at different point of time, depending upon the product segment and the borrower. So it will not be fair to extrapolate very simply. But overall, the average rise what we have given is 0.3%.
Okay, sure. I'll get back in the queue. Thanks a lot.
Thank you. The next question is from the line of Madhuchanda Dey from Money Control. Kindly proceed.
Hi, sir. Thanks for taking my question and congratulations on very strong quarter. I have a couple of questions. The first one is, as you shared the disbursement figure of 2,262 crores, of which you mentioned about 235 crore through fintech. So if you could just elaborate on the other channels in this disbursement mix.
So through our retail asset channels, through our NBFC partners, the total disbursement is 882 crores, and through our direct channel is 1,380 crores.
And the rest was through the
No, so this 230 crore is a part of this 1,379 crore.
Okay.
Of retail.
Okay, got it, ma'am. My second question is a bit of a repetition, if my understanding is correct. You mentioned that, of course, the OPEX has increased now to a level of more than 2% of total assets. So is this the trajectory going to be for the foreseeable future, given that the business is... Hello?
So that will be the trajectory. And once again, I would like to reiterate that our focus will be on ROAs. So just to give you the heads up on trajectory, it will be in this range or even higher. But depending upon the retail assets we create, it will not impact our ROAs.
Okay, I got it. The focus will be to maintain the 3.75 to 3.25% ROA.
Right.
Yeah. Got it, sir. And sir, my third question is on the NIM. You have managed to maintain the NIM, despite the rising cost of borrowing. And what are the levers which are available at your end, which gives you confidence that even should the interest rate rise from here on, you will be comfortable in maintaining the NIM at this level?
So if we take two sides of the balance sheet, that one is how we raise the fund. So majority of the funds we raise is MCLR backed. So we get a time lag impact of the MCLR triggers whereby they can raise the rate. The very strong track record whereby we can impress upon the banks to reduce the premiums what they were normally used to charge. So on the liability side, we'll try to be as efficient, and we'll like to prolong those impact of the interest rate hike as much as possible. This is on the liability side. And on the asset side, as I shared, we have more than 70% of the portfolio whereby in a situation where it is inevitable for us to raise the rate to maintain the given means, we are in a position to do that. And as I shared in the earlier query, that we raised 0.3% during the duration of the rate hikes of total 1.9% in the repo rate. So these are the strong enablers on the asset and the liability side, which gives us a reasonable confidence to maintain the NIM, and we demonstrated that in Q1 and Q2 both.
Sir, a very last question. It's a very general question, a little long term. We are increasingly seeing banks penetrating deep into the so-called Bharat banking and getting into the turf which was originally a forte of NBFCs like you. So how do you comment on that, and how do you see your business shaping up in light of this competition?
Okay, we are blessed to be in a country which has enormous potentiality. When we talk about Bharat banking or rural banking, NBFCs, or even the regional rural banks or the local area banks, whatever you call it in the current avatar, all together still are not at the scale to satisfy the massive exclusions that this country has. And when we are talking about extending credit in the segment where we work very actively, we all are talking about just the top 15 to 20% of the segment, yet 80% has to see the light of the day on the formal credit. So what we have seen through our experience that more the players, the better it is in terms of awareness, and it helps us to expand the market size. And at the same time, the sensitivity of the dynamics of the business also increases among the lenders. So there are multiple advantages of more players being entering the area where the market size are huge. And having said that, we are a niche player over all these years. We have high level of efficiencies, so we do have the wherewithal to stand the competition also. But I think competition is still a few years or a decade away, where it will be just be played on the interest rate. Currently, it is all about how you identify the demography, how you identify your customers, how you give them better services, and last but not the least, how you can maintain the quality of assets while extending the loans and bringing millions under financial inclusion. So my take on this is that more the players enter, better it is for companies like us.
Thank you very much, sir, for patiently answering all my questions, and all the best.
Thank you.
Thank you. We request participants to kindly restrict your questions to 2 per participant. The next question is from the line of Amarnath Bhagat from Ministry of Finance of Oman. Kindly proceed.
Yeah, hi sir. First of all, thanks to perform better than what you have projected in the last 2 quarters. You always say 20-25%, but actuals are coming 30%, way above than what you projected before. I hope that continue. I have 2 sets of questions. First of all, we know this Reserve Bank of India in the last few months itself increased by 1.9, and you say it is all your borrowing, most of them are MCLR based. Then how the FY22 your cost of borrowing is around 8.75, but by the end of Q2 it is just 8.83, and just few basis point increase in your cost of borrowing. How it has actually happened then?
See, as I shared, when we have a MCLR-backed borrowing, there are reset dates. That it is 1 year MCLR borrowing, 6 months MCLR borrowing. So the rates are benchmarked to MCLR and the terms both. So with the recent rise, we have had the advantage, as I shared with in the earlier query also, that we had an advantage to prolong those rise in interest rate because of the period triggers. So say for example, I have majority of them and have 1 year MCLR. So the earliest they can raise the rates is after 1 year. So this is the advantage of having an MCLR based borrowing. So if this remains very sustained, if this remains for a very sustained period of time, then our rates will also increase.
Yeah, that means, am I understanding that this is at the moment is not reflecting because you got this advantage, but over say 2 quarters down the line, which has been not increased, now it will come to increase to the next 1 quarter or 2 quarter line the line, and your cost of borrowing will proportionately increase more?
As I shared, if there is a sustained increase, then definitely we are also no exceptions from this cycle. So once the increases on a sustained basis, our rates will also go up. But during that period, we will have a lot of opportunities to streamline our liability and manage our liability more efficiently, so as to have the interest rate within the given target range.
Well, this is something very exceptional happened at your company compared to the similar size NBFC what we have seen the result at so far. Anyway, my second light of the question is, now your time gap between increase of your cost of borrowing and increase of your yield or the interest rate for your customers, is there is a gap? That means your liability cost come at a later stage, whereas you increase the cost of the cost of your borrowing to the others at a faster pace, and that gap generally give you a better NIM for the short period of time?
As I shared, we have increased on an average basis around 0.3% for our borrowers. So that is almost equivalent to the raise we got on the liability side. So as such, it is not a pleasant experience with the customers to raise, at least in the retail segment, to raise the rates often. So our endeavors are to have a very stable rate. But as I shared, once we reach a situation whereby it is inevitable to raise the rate, we start raising the rate. So to the extent it doesn't hamper our means, or if it is beyond our capabilities to absorb that, given our targets of means, we transfer those rates to the borrower. So we try to match the rise and raise, the rise we get and the rise we do.
And your unsecured loan part, sir, I'm sure for the last 2 quarters you've given focus on that particular part as well. Now, as of today, what is the status? Means how much of your total percentage, I'm sure it is minuscule, how much of your total percentage is really an unsecured loan? And if you can give us some kind of an outlook that how you are seeing this unsecured part of your portfolio is growing. Will it be growing faster than the growth of your other part of the portfolio, or it will be at par with that?
The micro enterprise loans where the ticket size are less are majorly the unsecured loans, and the others are all secured. If it is SME is secured, two-wheeler is, as the name suggests, is against two-wheeler, and commercial vehicle and used car against the assets. And what we do in home loans are the secured loans. So annual micro enterprise loans forms approximately 30-35% of our AUM configuration, and going forward we see this configuration to be maintained in the same proportion.
And you want to increase the leverage more than what you are now?
To interrupt, sir.
This is the last. It is relating to that one only. So just want to know about this leverage part, which has been increased quite a bit compared to the previous part. Is there an intention to increase this leverage more than 4.2? Because this 4.2 itself is last 4 years or 3 years highest.
So we don't plan to increase more than that, and it might be highest, but it is well within the industry norms, and it is looked from the angle of the capital adequacy we maintain. So at a capital adequacy of 24%, the lenders are more than comfortable with this leverage. So I think we'll be maintaining, and as we grow our balance sheet size, it will not be possible for us to maintain low leverage, because that will be hurting our ROEs. So I think this is an optimum leverage what we have reached, maybe something in the range of 4 to 4.5 times, and with capital adequacy of 24, more than 20%, we get good lender support.
Thank you. Thank you, sir.
Participants are requested to kindly restrict your questions to 2 per participant. The next question is from the line of Subhranshu Mishra from Phillip Capital. Kindly proceed.
Thank you for the opportunity, sir, and I wish you a very happy new year. Coming to the question, sir, the first one is on the contribution from our NBFC partners. We generally used to put this out on our PPTs earlier. Wanted to understand what proportion of our AUM are we generating from our NBFC partners. Also, wanted to understand in the credit cost that we have seen this quarter, what's the write-off proportion? Also, if you can talk a little bit more about our collection architecture for micro enterprise loans and SME. How many people are deployed in various geographies? What are the kind of incentives that are given? Any collection agencies if they are deployed? Thank you, sir.
Happy New Year to you. I'll not be answering in the order of the questions, but the way it comes to my mind, in terms of the number of persons employed at various geography will be shared offline with you by Ankit. But for just to give you the fundamentals of it, that all our business is backed up by banking-based collections and banking-based disbursements. So we just have to address the issues where there is dishonor of the RTGS or NACH on time. and the number of people employed in-house and through agencies will be shared by you offline. The configuration, I think we have mentioned in our presentation, around 40% is through NBFCs and 60% is through our direct channels.
Understood, sir. And going forward, the contribution will keep falling?
Yes. Once again, I'd like to reiterate that we are very happy and satisfied with both the distribution models. But the only thing is that since our retail distribution grows at a faster pace as compared to our NBFC distribution, the configuration looks more lean towards the retail distribution. And as I see that, I think on few quarter basis, on a year or two basis, I will see this settling anywhere between 30 to 35% through NBFCs and 60 to 70% in favor of our retail distribution.
Right. And just one clarification, sir. This credit cost that we see on the P&L, that's only from our originations, not from our NBFC partner originations. Is that correct?
Credit cost. Credit cost you are asking about?
Yeah. The provisions, the impairment on financial instruments that we see, that's the credit cost on the P&L.
That is on both, because that is on both, because even we have to have a standard asset provisioning also.
Okay.
So when we talk about provisioning, it is for the complete on-book portfolio.
Right. So it is for both our originations as well as our NBFC partner originations.
Yeah.
Understood, sir. Sure, sir. I'll take the rest of the questions offline. Thank you.
Yeah.
Thank you. The next question is from the line of Deepak Sunavni from Haitong Securities. Kindly proceed.
Yeah. Thank you, sir, for the opportunity. So my question on our fintech disbursement in quarter. As we can see that currently we disburse around 235 crore as compared to last quarter of around 300 crore. So we have seen kind of dip in the disbursement. Any specific reason behind this?
There is a lot of regulatory overhang. If you say the RBI was supposed to come out with the guidelines, and then the guidelines coming, the interpretation of the guidelines, and then how we have to structure our business in compliance with the guidelines was very important. So we took a cautious decision not to accelerate the disbursement unless we are clear on the guidelines. So now the guidelines are pretty clear. There are guidelines and then queries, and they were answered by the RBI. So now we are very clear on how we should conduct ourselves in terms of doing business with various fintechs.
Okay. Thank you, sir. So and what is the average yield that we are offering to our customers through salaried personal loans?
Salaried personal loan, it ranges according to the customer profile. It ranges from 14 to 19%.
Okay, sir. As a last question, just a data keeping question from my side. If you can give us the stage 3 asset percentage as of September for all the two-wheelers, CVs, micro enterprise and SMEs, it is great.
So that we will share it with you offline, or if you can quickly give it to them.
Just a minute. So two-wheeler stage 3 asset percentage is 1.68.
Okay.
MEL is 1.54.
Okay.
HPL is 0.47 around.
Okay.
Then SME loan is 1.10 and SRTO is 2.47.
Okay. Thank you, ma'am. Yes.
Thank you. The next question is from the line of Himanshu Upadhyay from O3 Capital. Kindly proceed.
Hello.
Yes, sir, we can hear you.
Yeah, my questions have been replied here. Okay, so I don't have any further queries. Thank you from my side.
Thank you. The next question is from the line of Sarvesh Gupta from Maximal Capital. Kindly proceed.
Good evening, sir, and thanks a lot for taking my question. And congratulations on a good set of numbers. So, sir, one thing which I wanted to just clarify is against this repo rate rise of 1.9%, so we increased the rate by around 30 basis point only. So, is it sort of, I mean, this is very different from other NBFCs, of course. So, does it also lead us to getting a lot of balance transfer or something like that, from our existing customers because, they would have seen that your rates are much lower than what is being offered in the market because obviously for the other NBFCs, rates would have increased, especially in this period.
So if you see the borrowers whom we deal with, for them interest sensitivity is not that high. For them getting the loans at the right time and relationships plays an important role. So we are not practically seeing a lot of balance transfer happening because of this. And at the same time, for the new borrowers, the rates have already increased. When what I'm talking about, the rate rises of the existing borrowers. For the existing borrowers, we try to maintain on an average. What I'm talking 0.3% is on an average for the whole AUM. There might be cases where we might have raised 0.5%, some for some 0.6%, depending upon the borrower's profile and the basic interest rate we used to charge to them. If the basic interest rate charge is less, we had more room to increase. So we could manage on an overall basis at 0.3%, and the new rates have already increased. This was for the legacy portfolio. So we did, practically we could not find such much of this opportunity in the market.
Understood. And secondly, sir, now that we are almost on a 30% sort of a growth trajectory versus our maybe ROE of around 15 odd %, so we will be consuming capital quite fast. So are there any thoughts around equity fundraise, if not this year, then next year?
30% has been since last 2 quarters. We still stick on to our original targets that as a company we target anywhere between 20 to 25%. But because the COVID situation, we had got room in having extra capital as buffer. So we are seeing strong traction this year to grow at 25% plus. And with 25% plus growth rate, de-risking it to the extent of 20-25%. And ROS between 2.75 to 3%. I think will fuel our growth for at least next 2-3 years at the same rate.
Thank you and all the best.
Thank you. The next question is from the line of Ankit Gupta from Bamboo Capital. Kindly proceed.
Yeah, thanks for the opportunity and congratulations for a good set of numbers. Sir, on the cost of borrowing front, assuming the MCLR hasn't hit us as of now, the rate hikes. So, assuming over the next 3 to 4 quarters, when this MCLR revision hits us, where do you see your cost of borrowing, let's say in Q1 or Q2 of next year?
As I answered in to an earlier question, that if it is on a very sustained basis, there are no exceptions that our rate will not increase. But we'll get time to create the assets accordingly, and ultimately we will be in a position to maintain our NIM at the same level which we are operating right now. So this is what we visualize as of now. That since it is MCLR back, we get some time to recalibrate our assets and liabilities. So our rates might increase, but we may be in a position to maintain our needs. That is what we think.
Sure. So for the new customer acquisition or for the new loan that we are sanctioning, have we also taken this 30 bps hike, or we are giving them loans at higher rate of interest?
It is at higher rate, because we have to factor in that what the marginal cost of borrowing for us also will increase. So we have to factor in that, and depending upon the product and what best the market can absorb, depending upon the product, those rates have increased.
Sure. And sir, I think Sarvesh also asked about capital adequacy ratio. We have touched almost 24%, and we are targeting, let's say, 10,000 crore of AUM by end of FY24. Any plans of fundraising as of now?
The way we have designed our model for up to 10,000 crores, we don't see any requirement of fundraising, presuming the capital adequacy at around 20% plus. And beyond that, it all depends upon the growth we pursue and the opportunities we get in terms of capital raise. So it is never say never to capital raise, but what point I'm trying to drive home is that to grow at 20-25%, it will not be imperative for us to raise capital to grow at those rates. Because we de-risk around 20-25%, and we already have a capital buffer currently. And we also have the potentiality to raise Tier 2 capital from time to time. So combination of all those things will help us to keep around 20% of capital adequacy ratio and can grow anywhere between 20-25%.
Sure. And so just one last question, if I may just squeeze in. So, last two quarters, we have also seen significant growth in our micro enterprises loan and although SME, as you have guided earlier, continues to be the major growth driver for us. So, given the current scenario, how do you see the growth in segments where we lend to SME, NEL, and Wheels? So, over the next year or two, how do you see the growth in all these segments panning out for us and our strategy for growth in this each segment?
All these small enterprises, the growth rate is pretty high. If you leave aside the 2 years of COVID, and that is what I shared with all of you in my opening remarks, that growing our AUM at around 25% plus has been our style of working or the way of working over all these 2.5 decades. And the same was the function of the borrowers whom we work with. So they grew in size, and that gives an opportunity to serve them. And we could also continuously grow at around 20-25% along with them. So I think with things normalizing, we see this enterprises not for only a year or two, but for a very sustained period of time, we'll be in a position to register a very healthy growth rate. And at the same time, they will give us good opportunity to grow along with them. This is what we have experienced over 25 years.
Sure. And on wheel side, how do you see growth? CVs and two-wheelers?
If we have a stable GDP growth of anywhere around 6 to 7%, we see this within next 2 to 3 years is contributing progressively from 12% to 15% to 20%. This is what our endeavors will be. Maybe few percentage here or there or few quarters here or there. But in long term, we anticipate this to contribute around 15 to 20%.
Sure. Okay. Thank you, Mr.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for any closing comments.
So thank you, all of you. I think we were in a position to answer your questions. And in case if you have further queries, you can be in touch with our IR team, and you can get the reference of the right. And I wish you all the best, and thank you for patiently hearing to us. Thank you.
Thank you.
Thank you.
Thank you.
On behalf of Motilal Oswal Financial Services Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.